Welcome to the Trade to Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as copper, gold, oil, and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only, doesn't take your personal situation into account. With all of that said, let's jump over to our first chart. So I have the S&P 500 up here on the screen, and this is one of the most interesting situations I've seen for years. So let's start with the recent price action. And what we've got the S&P 500 just starting to lift out of this short-term compression over the last couple of days, and this has really given us some quiet trading over the last 2 weeks. And what I think is when you get these pauses, when you get an upward trending market, you get the pause, you get the breakout. The pause is generally a good thing because I find rallies tend to be more sustainable when they pause to consolidate, and that's what we've had. We've had the consolidation. Now we're getting the breakout. So all good from that perspective. And the breakout takes the S&P 500 to an all-time high. So by my count, that is 33 all-time highs so far this year. Now, some people hear that and they'll go, 33, that sounds like a lot of all-time highs. That's concerning. But the thing is, all-time highs tend to lead to more all-time highs. So they're actually a good thing. What is interesting is when you look back over history, the most all-time highs in a calendar year was in 1995. There were 75 all-time highs in that year. Plenty of other periods where there'd been, say, 30 or 40 or 50s, somewhere in there. So where we are now at 33, it's not really extreme when you look at the number of all-time highs from previous periods. So I think what we deduce from that is that the path of least resistance is up. From a pure price action perspective, this is a healthy upward trend in that we have higher highs, higher lows, we have rising moving averages. I've got the 50 and the 100-day moving averages. So from that point, there's nothing bearish here. It's a bullish trend. But, and there is a but, there is a notable risk factor that I think we at least need to be aware of. When we're aware of risk, we can be better prepared to manage risk. So an important factor to be aware of. And it is a well-known fact, and it's that this is a narrow rally. It's being led by a handful of big tech names. And most of the stocks within the S&P 500, most stocks were in the market overall are just not participating. I'm going to show you what I mean in a moment. And I'm also going to tell you how I think we play this current situation. First of all, though, if you're getting some value, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. Just tells YouTube you're watching, you're engaging. YouTube shows other people, helps me heaps. Please do that. Please also click that subscribe button if you haven't already done so. Now, what I want to do, take a mental snapshot of this image that we have here, the S&P 500. Contrast that with this graph here, the S&P 500 equal weight. It's an ETF. And so, of course, an equal weight is weighing the largest stock, giving the same weighting to the largest stock as the smaller stock within those 500. And what we have here is a completely different story. The broader market is just not confirming the highs we're getting in big tech. So it's very much a two-speed market. Big tech is running hard. Most of the other stocks are consolidating. In fact, just over half of the S&P 500 stocks are currently below their 100-day moving average. Have a look at this graph here. So this is the S&P 500 stocks above their 100-day moving average as a percentage. And you'll see it's currently only 46% of stocks above their 100-day moving average. So we have 54% below their 100-day moving average. So that's not a particularly bullish setup, that fact on its own. I'm watching this level down here, 44%. It's been down here a couple of times in the last month, touch above there, a bit before that. If we start to see the number of stocks start declining below 44, heading down towards 40 into the 30s, well, then the internal structure of the S&P deteriorates further. So that's something I think we need to be aware of. The strength we're seeing in the index is just not being reflected in the majority of stocks at this time. Coming back over to the equal weight, and just looking at this, it's been in this trading range since March, since late March. It's really been trading sideways, and you can see the upper end of the range, this blue downward sloping line, that's showing us the top of the range, the bottom of the range. The 100-day moving average is doing a good job at containing prices on the downside. And the last month, we've started to see a smaller range develop. So let me just trace that in for you. You can see this narrow trading range, which has just developed in the last few weeks. So you really can see how the price action is coiling up. It's coiling up along this 100-day moving average. Now, this isn't necessarily bearish. We don't have a breakout. We don't have a breakout to the downside. We don't have a breakout to the upside. It's a holding pattern. We really need to see which way this is going to go. We've got to wait for the market to show its hand. If we get a break to the top side, well, it's bullish. And then we can see that S&P 500 trend continue to extend. But as I say, we don't currently have that upside break. So as it stands, we've got non-confirmation, and that is a risk factor. So how do we play this? Well, I think this is an interesting situation on its own. So some people are completely dismissive of the equal weight. They say, why do you look at it? It doesn't matter. Others say, look, this is bearish. It's bearish that we're getting this non-confirmation. It's time to get out of the market and go short. I've got a different take on the situation. I think we still have a bullish chart structure in the S&P 500. We can't. I don't think we can ignore that this is, by all definitions, a bullish chart structure, as I described earlier. So I think the base case continues to be stay long, let profits run, whether it be on an index level, whether it be individual stocks which are trending, and even though most are below their 100-day moving average, there are still other stocks other than big tech which are trending. So if something is doing well, let it keep doing well. Same applies for the NASDAQ and NASDAQ stocks. But don't be blind to the risk that we've just been through with what's going on the internals of this market. If you buy the index at the moment, well, you're kind of really buying a rally in a few big tech stock names. That may prove to be okay, but just be aware of what it is that you're actually doing. This is not a broad-based rally, at least not at the moment. Well, having said all that, I think we might leave that there for this week. Thank you for joining me. Hopefully that's been interesting. Hopefully it's been helpful. Look forward to coming back, talking to you again next week. Till then, bye for now.